expert as well, Sandip Agarwal, the Executive Director, Institutional Equities at Nuvama Group, now joins in. Sandip, morning, and thanks so much for joining in. We've seen some pretty sharp earnings downgrades on Wipro. You have brought down your EPS estimates by 8.4% for FY23. FY24 EPS estimates are lowered by 5.3%, and even FY25 earnings expectations have been brought down by 6%. Can you tell us where was the big miss, and what did you make of the management commentary?
No, so see, the earnings cuts are primarily led by cross-currency impact. There is huge appreciation of other currencies versus dollar. So while, we get some benefit on the INR, but most of the other currencies are hurting us very badly. And because of that, there is a change which we have done. Over and above that, we believe that Wipro's margin trajectory has changed a little bit. So this 5-7% cut which you are seeing is broadly a few basis point of margin cut, which is resulting to a bigger number in terms of EPS cut, which is a mixture of, again, cross-currency impact and also the trajectory change which has happened. Wipro has 2 months of wage hike which will be taken into account, which leads to higher cut for this year, because we were expecting a little better margins and it has come slightly lower than what we have anticipated. But having said so, we continue to believe that demand remains very strong in the industry, and growth will remain strong going forward. Margins will recover from here for the sector as a whole, because attrition has peaked out and it will start cooling off substantially from here. So we maintain our positive stance on the sector as a whole.
Right.
Wipro Tech will grow little lower than the Infosys, TCS, and HCL Tech within the pack.
Sandip, cross-currency has impacted all the IT companies, but for HCL Tech and TCS, you've not lowered the EPS estimates to the same extent. The tweaks have just been about 0.5, 0.6% thereabout. Can you tell us how your margin estimates for Wipro have changed? What was it that you were earlier projecting, and what is it now?
So see, you are right. In case of TCS and HCL Tech, what has happened, if you see, both the companies have delivered slightly better margin than what we have anticipated. So we did not have to take any cut in margins in the current quarter. While in case of Wipro, the margin estimates were almost 30-40 basis point, lower than our estimate, and versus street also it was lower than, I think, 20 basis point. So because of that, we have to make this change. We were earlier building in a stronger recovery in margins around 16.5%. But now we are cut down that by 40-50 basis point, and because of that, this change is happening. Other companies, like as you mentioned, TCS and HCL, they have been able to manage their margins through operational efficiency, their realization. If you see, HCL Tech has got almost 115 basis point of delta from pricing alone in the IT services piece. So there is little bit of divergence because of that.
Just one word on Wipro. You were earlier anticipating margins of 16.5% by when? And now what is it? What's the number?
So we were expecting 16.5, 16.7 for next year, which 24. Is now cut by 30%. Yeah.
Okay. What about HCL Tech? HCL Tech has positively surprised on growth, and now HCL Tech services revenue is going to outpace all the peers, including Infosys, TCS, etc. And its valuations are also relatively cheaper. Is there a case for, if someone has to buy IT, money moving to HCL Tech, investors preferring HCL Tech because its growth is faster now compared to peers?
No, so see, always it has been the case that, HCL Tech is a late cycle play. So when the cycle begins, then, TCS and Infy always lead the performance, and then, followed by HCL Tech, because they have a very high concentration of IMS piece, which are transformational in nature and takes longer time to convert. If you see the simple logic to see Indian IT from an overall perspective is that in last 3.5 years, almost $550 billion of cloud has got sold, hyperscaler sales have happened. And to implement that, different companies have different number, but the minimum number should be $1.25 trillion over next 5 years to execute that, of which almost 70-80% has to be global sourcing. So we are talking about 700 billion, of which probably Indian IT should get 550 billion over next 5 years. So we are talking of $120 billion incremental revenue every year from implementation of this cloud piece alone. So I think that the industry will do extremely well over next 4 or 5 years, and within that HCL, because of its higher concentration of IMS, should do even better. That is the way we are projecting.
All right. Thanks very much, Sandip. It's always a pleasure having